Hello, everyone. I'm Kevin Miller. I'm the CEO of the E-Valuator funds, and this PowerPoint video is going to review the performance of the bond market and stock market in 2022. We're going to look at 5 major asset classes. We're going to compare the performance of the evaluator funds to those asset classes. We're going to talk about some economic indicators, and then we're going to talk about our 2023 outlook. So if we start off talking about the bond market, one way to measure the performance of the bond market is to track the performance of the U.S. 10-year Treasury, and the Treasury bond. Anyway, you can see based on this graph provided by Bank of America that the U.S. The 10-year Treasury performance in 2022, the last time it was at that level or worse was 1788. So this is an incredibly uncommon occurrence. And just to give you some perspective, to make sure I didn't mistype 1788, George Washington was the president back in 1788. So what we just lived through in the bond market last year is not a very frequent occurrence. So hopefully we got good things to look forward to going into the future here. Another thing that took place at the end of last year, 2022, was we had 2 consecutive years where bonds posted negative returns. That doesn't happen very often. The last time it happened was back in 1958, 1959. And you can see, as this slide points out, it's never had 3 consecutive negative return years. So hopefully we'll see a positive return in bonds by the end of this year. What caused that? The Federal Reserve. The Federal Reserve raised interest rates at a very aggressive pace throughout 2022. This shows you their raising history going back to 1987-89. You can see that the line for 2022 is much more vertical than any of the other periods. Again, 87, 89, 99, 2000, 94, 95, 2015, 2018, 2004, 2006. This is a historical perspective of that Federal Reserve funds rate. You can see that in 2001, it was over 6%. But then what happened in 2001 was, or excuse me, from March of 2000 down to October 2002, the S&P 500 lost 49% of its value. So the Federal Reserve lowered their rate from over 6% down to under 1% to help stimulate the economy. Then came the housing bubble, where the stock market, the S&P 500, peaked in October of 2007 and went down by 56% in March of 2009. So what did the Federal Reserve do? They lowered interest rates from a little over 5% down to 0. Then you can see that they stair-stepped it up starting in 2016, and then 2017 through 2019. They're going through a series of rate increases. Then COVID hit. Stock market, S&P 500 went down 34% from February of 2020 to March of 2020. So in response to that, the Federal Reserve lowered interest rates back down to 0 again. Then in 2022, in January, the stock market peaked, and then from January through into October, it lost 25% of its value. But this time, instead of lowering interest rates, the Federal Reserve was in the midst of fighting inflation, so they're raising interest rates. Well, when the stock market is going down, stocks are posting negative returns. When interest rates are going up, bonds typically will post a negative return. So this is the development that we were in when we came to 2022, is bonds were posting negative results and stocks were posting negative results. This is a table that shows all the bond fund categories that Morningstar has assembled that we use inside the evaluator funds. To the left of each category name is the number of investments in that category. Then to the right, each column underneath each month identifies the average return for that category. If, for instance, here in June, except for money market, all the other categories for that month posted losses because the numbers are in red. But then in July, everything posted a gain. So we can see month by month. We can see the most recent 3 months ending December 31st, and then we can see for the year. When interest rates are going up, you want to avoid long duration bonds. And that's highlighted right here because you can see long-term government and long-term corporate bonds for the year posted losses, from a negative of 29.97% loss to the long-term corporate was minus 24%. We have not had money in long-term bonds for probably 2 years now. What we did early on last year is we shifted all of our fixed income duration holdings into a more short-term duration. So we have holdings in ultra short, short-term, and bank loan. Now, we weren't able to avoid a loss for the year, but our losses were much less significant than if we would have kept that money in intermediate duration bonds or long-term bonds. So now let's look at the stock market. Like the previous table, this shows you a variety of categories that Morningstar has assembled. Above the gray row, these would all be domestic stock categories. The large identifies the size. There's three components. There's size, there's domestic, and then there's also the management style. So these are all domestic. Large companies would be 10 billion or more in size. Mid caps would be 2 to 10 billion. Small would be less than $2 billion in size. Management style, growth is more momentum based. Value is more want to buy it at a good price style of management. A blend would be a little bit value and a little bit growth. So it'd be the combination of the two. As you can see out over here, large cap value on average was down 5.9% for the year. Large cap growth was down almost 30%. In fact, if you looked at every type of security, large, mid, small, domestic, global, or foreign, in every one of those instances, value style management performed better than growth style management throughout 2022. Thankfully, about after the first quarter of 2022, we migrated a lot of our equity holdings from foreign into global and into domestic, large and mid cap. So we kind of got out of the foreign, underweighted that. And then we also overweighted value style management and got away from momentum based growth. So to kind of give you a perspective relative, how this year performed relative to other years, this shows you the performance of the S&P 500 and the performance of a bond index called the Bloomberg Aggregate Bond Index. So where the blue dot resides, that tells us how well stocks as measured by the S&P 500 and bonds as measured by the Aggregate Bond Index performed. Now this goes back to 1976. The stock market is represented by the vertical line. So if you go to the right, that means stocks did positive for the year. If you go to the left, it means stocks posted losses for the year. Bonds are represented by the horizontal line. So if you go up above horizontal, it means that the bonds posted positive for the year. Below horizontal would indicate bonds posted losses. So if you look over here at 1985, you can see that from left to right, it's past 25%. So stocks would have had posted over 25% gain for that year. And then if you go from 0 up, you can see that the blue dot is past 20%. So that would have been a great year because bonds would have posted over a 20% gain and stocks would have posted over a 25% gain. Now, if we go and look at where 2022 fell, again, the reason we show you this is just because we want you to understand that this is really uncommon what took place in 2022. If you go from the vertical line left, you can see stocks were down almost 20%. And if you go from the horizontal line down, you can see bonds were down about 15%. There's been only one other time where we've seen stocks and bonds down to a significant, a measurable amount, let's just put it that way. And that was 1994. That blue dot right above my marker indicates that stocks posted a loss and bonds posted a loss. Almost always one or the other has posted a gain, with the exception of 1994 and 2022. Now let's look at 5 major asset classes, because the reason we're showing you these asset classes is because each evaluator fund allocates some of its money into each one of these asset classes. So for money markets, for our benchmark, we're going to use the Morningstar pool of money market funds that they capture and they monitor and they create an average for. So it's Morningstar's pool of money market funds that they track. For domestic bonds, we're going to use that Bloomberg US Aggregate Bond Index. It's the most common bond index out there. For domestic large cap stocks, we're going to use the S&P 500. For domestic small to mid cap stocks, the index will be the Russell 2000. And for foreign stocks, we're going to use the MSCI EAFE index. All very common standard indexes for each of these asset classes. You can see the returns for each of these asset classes or each of these indexes as of December 31st. You can see 3-month, year to date, 1 year, which happen to be the same since it's calendar year end, 3-year, 5-year, 10-year. You can see money market has posted a positive result across every time frame. You can see that bonds for the year were down 15.4%, which brought down the 10-year average into negative territory at minus 1.56. You can see domestic large cap stocks on average were down about 19.4. Small to mid cap domestic stocks were down about 21.5%. And international stocks were down almost 17 at 16.8%. Okay, now you're going to see this component of the table on the next 6 slides. But in addition to this, you'll be seeing what the performance of each evaluator fund has done relative to these peers. So we start off with very conservative. The 0 to 15% identifies the minimum and maximum this investment could have in stocks at any time. So it's the stock allocation rate. Right now, it has 3% of its assets in stocks. Okay. So if we were to break that down, you can see that for the 1 year, this fund posted a negative result, minus 6.68. For the last 3 years, it's been positive 0.2, 1.1, 1.41% average per year for the last 5 years, 2.28% average per year for the last 10 years. Now, let's say we were to take the asset allocation of this investment and spread it across these indexes. We would say, okay, this investment has 1% right now in money market, about 96% in bonds, 2.4% in large cap, 0.5% in small to mid, and 0.2 in foreign stocks. So then what we would do is we would allocate that same, align that same percentage against the performance of each of these benchmarks. So if we wanted to figure out what the blended return was of an asset allocation across these asset classes, we would take the percentage that you see in this column, 1%, 94, 5.9, 2.4, etc. We'd multiply that times the 1-year return of each benchmark, which you can see the 1-year return up here mirrors this. And then we would total that up. So we know that if we were to would have just allocated the same amount into money market bonds, large, small stocks, and foreign stocks, that the blended rate would have been about a minus 15.38. Well, that's what the blended asset class performance line, this gray line, represents. So for the last 1 year, this fund did -6. An identical allocation across these indexes would have resulted a -15. +2 compared to -4, excuse me, +0.2, +1.41 compared to -2.1, +2 compared to -1.2. So we provide this blended asset class performance for you for comparative purposes. So you can compare, well, geez, how well was this investment? Well, compared to their peers with an identical asset allocation, this is what you would end up with. This is the disclaimer that we need to have posted every time we show returns. And it just basically says past performance does not guarantee future results. You know, when you redeem your shares, you could have more than what you put in, you could have less. And, you know, you can reach out to us and ask for more information. So you'll see that disclaimer on every slide going forward. So now we're going to look at the conservative 15 to 30. It'll always have at least 15% in stocks, never more than 30. Currently has 18 because we're defensive. You can see the expense ratio. You can see the 1-year return was -9. 3-year average per year was 1. 5-year average per year was 2.4. And 10-year average per year was over 4%. Now, again, we take this percentage that we would have allocated into each across those 5 asset classes, multiply those percentages times the performance of each index based on the time frame to arrive at what a blended asset class performance is. So this is this is an illustration of the 1 year where we take 1% times 126, add it up. So this investment was down 9.33. If we had taken the exact same asset allocation and spread it across these 5 popular indexes, it would have netted a negative 15.95% return. So just to cut to the chase, if you compare this row of returns to the returns in the gray line, you'll see how well this fund is performed compared to doing the same asset allocation across these generic indexes. The conservative moderate will always have at least 30% in stocks, never more than 50, currently at 34. And again, you can see the difference between what this fund posted for gains in comparison to what the blended average of those 5 major asset classes would have generated. The one point we need to make on this fund is that prior to January 31st of 2019, this fund was managed as a tactically managed fund. Then come February 1st of 2019 on, we've managed it in this 30 to 50% asset allocation range. So some of the performance attributed to 5-year and 10-year would have been when this fund was being managed as a tactical fund as opposed to an asset allocation fund. The moderate will always have at least 50% in stocks, never more than 70, currently at 54. 1-year return negative 12.96 compared to in a pro rata asset allocation across these 5 asset classes would have been negative 17. 3-year per year 2.6 compared to 0.24. 5-year 3.73 compared to 2.8. 10 years 6.2 compared to 4.2. So again, very good performance relative to the benchmark identical asset allocation. Growth, we'll always have at least 70% stocks, never more than 85, currently 73. Here's the 1-year return, minus 14.7 compared to a minus 18 if we would have just invested it in these indexes at the same percentage allocation. 3 years at 3.8 compared to 1.944 compared to 3.6 for 5-year, 10 year 7.6 compared to 6.2. And then the last investment would be the aggressive growth. This one will always have at least 85% in stocks. Right now it only has 87%, so it's at the lower end of the scale. It has about 8.8% in foreign stocks, 13% in small caps, 65% in large caps. The rest would be in fixed income or money market. You can see the blended rate across those indexes would have, for 1 year, would have generated an minus 18.9% return, which in comparison to the fund doing minus 15, the fund actually would have done better than just putting the money into these indexes. The 3-year return was 405 for the per year for the fund compared to 341 for the peer group average. The 5-year return of this fund is the only time frame of any investment that, as of 12/31/22, that was lagging the average of the asset class blended performance. The 5 years at 4.6, where the asset class blended performance would have been 4.9. The reason this is lower is because we got quite defensive, expecting the stock market to sell off, and we did not participate in most of the gains in the latter half of 2021. So that did impact the 5-year average for that fund. Okay, now let's look at what we think might transpire, where we're at with certain key indicators, and how that will potentially impact the economy and the stock market. Housing is important because it makes up about 26% of our GDP. We can see new permits. When you build a house, you have to file a permit. That process takes 4 to 6 weeks, 4 to 6 months. So based on the number of permits that are being filed today, we know approximately how many homes are going to be started in the not too distant future. Well, you can see that new permits have been declining. So that's telling us to expect to see fewer housing starts over the next 4 to 6 months. Actual housing starts, as you can see, have been declining. So what was transpiring back about 6 months ago here is now starting to come to fruition through what we're actually seeing in new housing starts in the real estate market. So the next thing you have to ask yourself, are people not building new homes, but they're just buying existing homes? And that is not true, because existing home sales have been declining as well. Primary driver for all of this declining statistical analytics is the 30-year mortgage rate has doubled over the last 12 months. It's gone from 3.11% to 6.33% as of the end of December of 2022. So we would say housing is telling us that the economy is probably going to slow down. Therefore, the market could very well follow the direction of the economy. Now let's look at the consumer. How good is the consumer? Because our economy is 65% of our economy. 65% of our economy is driven by consumption, by the consumer spending money, not by government spending. Well, so we need a good, confident consumer. Well, you can see consumer confidence after this gray bar. That gray bar is a recession. Since the recession of 2020, consumer confidence has been kind of going down. So it's trending down. Likewise, personal savings rate. You can see how that has trended down substantially since just after the last recession. You can see it's starting to turn back up, and we want to see that because if people are saving money, that means they've got ample assets to live off of, and they've got some extra money to invest for future expenditures. Now, the bottom two slides are kind of concerning. To the right here, we have credit card and revolving debt. You can see that the amount of debt consumers are carrying is at an all-time high, and it's continuing to increase. And then on top of that, we're starting to see payment delinquencies or late payments or people not even paying their bills. That's starting to pick up. So that's very concerning because people have a lot of debt and they're not making their payments. So I would say when you look at those two things, plus the fact that consumer confidence is kind of trending down, I'd say the consumer probably isn't feeling the strongest right now. Employment actually looks pretty good. Initial unemployment claims is going down. People who are staying on unemployment, that's kind of peaked. That's starting to go down. Unfilled job vacancies, that's declining. And then we're not really seeing an increase in layoffs or discharges on these reports yet. So I would say that employment is probably one of the brighter spots as far as what our economy is, what's holding our economy together. Let's talk a little bit about inflation. So what you see here is 2019, year over year, how much inflation went up. So in January of 2019, inflation went up 1.6% year over year. February 1.5, March 1.9. Below that, we're showing you 2020. 2020 in January, year over year, inflation went up 2.4. Then in February, it went up 2.3. So you can see every month what the year over year inflation increase was. Then the yellow row just represents those two added together. So the yellow row represents the 2-year rolling inflation number. Okay, and you can see it stayed between 2 and approximately 4%, right in line with what the Fed wanted. Now, let's look at the next 2-year rolling inflation number. So we discard 2019 and replace it with 2020 and add 2021. And what you can see is that year over year, here in May of 2021, inflation year over year went to 5%, and it just kept going up. And that caused the 2-year rolling return to continue to increase, where by the end of 2021, inflation was up 8.4% over the last 2 years. So then let's look at 2021 and 2022. The point we're making here is that inflation really started picking up toward the end of 2021, and then it just continued to carry on forward into 2022 until it started declining year over year from June to July, and then you can see year over year it kept going down. Now the media is making a big deal out of this because they're like saying, hey, inflation's going down, but what they're not saying is the year before that it was up quite a ways. So to see that, you just look at toward the end of 2021, you could see it went from 5.3 to 5.4 to 6.2 to 6.8 to 7. So while it's declining in 2022, it's not declining a lot faster than it was going up the previous year. So ultimately, the 2-year rolling return since July has really been pretty much range bound from 13.9 down to 13.6, back to 13.9, down to 13.5. In fact, the 2-year rolling return at the end of December, 13.5, is identically where we were, almost identical, at 13.6 back in May. So when consumers say, geez, they say inflation's going down, but I just don't feel it. That's because for the last 2 years, the rolling inflation on a month-by-month basis has been relatively consistent between 13.5% all the way up to where it peaked in 14.5%. So inflation is going to have to go down pretty fast in 2023 for this 2-year rolling number to go down, because you can see how fast it's going up in the first half of 2022. We'll keep an eye on that. Recession. Everyone asks us if there's going to be a recession in 2023. We would say more than likely. This is a very good indicator where you take the yield on a 10-year Treasury bond, and you subtract out the 3-month yield on a 3-month T-bill. So if the yield on a 3-month T-bill is higher than a 10-year bond, then this blue line drops below zero. Okay, that means that it's inverted, right? You get more yield on a 3-month bond or bill than you do on a 10-year bond. And every time that blue line has crossed below zero, meaning the interest market has inverted, we have had a recession shortly after that. So you can, and the gray bars represent inflation, or recession, I'm sorry. So we can expect that with where it is today, at the point this was as of January 1st or January 6th of 2023, when this snapshot was taken, the difference between the 3-month T-bill and a 10-year bond was 1.12%. That's quite a difference. In fact, let me bring that up. This is the exact same slide. It doesn't go back as far as the 80s, so it's a little easier to see. This is very recessionary in its analytics. So we would suggest that we're probably going to see a recession sometime in 2023. So we're going to give you now 3 reasons to be concerned about the future of the market through 2023. Is the housing industry is continuing to trend downward. Consumer isn't totally healthy, and the historical recession indicator is substantially indicating that recession is about to happen. Reason to be optimistic and discard these 3 reasons for being cautious is: 1, unemployment remains low. 2, we have $5 trillion, more than $5 trillion in cash waiting to get deployed into the markets. So once the markets do turn around, that could help carry the performance for quite some time. And the 3rd reason is our 1-year returns at the end of 2022 were so far below the historical 10, 15, and 20-year averages that we will eventually revert back up toward that longer term average, because that's how you get a long-term average. You go through periods of where the market's way above the average, and you go through periods where market's way below the average. So when we get into a period where the short-term return, the 1-year return, is substantially different than the long-term average, we can anticipate a reversion back toward that average. Our strategies remain cautious. We're going to transition bond holdings into intermediate out of short-term. We're going to slowly rebalance our stock allocation back to a more normal allocation between value and growth. We're going to eventually put more money into equities, and we're going to watch for the Federal Reserve to announce that they're pausing their rate increases and maybe even potentially start reducing them. Our expectations is the Federal Reserve will continue to raise rates into the 2nd quarter of this year. We expect you'll see the potential of a recession in the 3rd quarter. We think the housing market will find a bottom in the last half of 2023 or early 2024. Long duration bonds will perform well in the last half of 2023, we expect. Stock markets will be volatile, but we think it'll still end up with a positive year. Federal Reserve may actually need to start lowering rates at the end of this year or the beginning of next year. And then we're also anticipating that we're going to make a pivot back to a gold back or precious metals back currency. And that currency could be traded in a digital environment. So I think we got some exciting things going on this year. It's just a matter of how they all play out over probably the next 6 months primarily. But typically, the third year of a president's term is typically good for the markets, and so hopefully that history will continue to sustain itself. This is just a disclaimer that identifies all the various notes that we have to make. You know, our funds are not FDIC insured. You know, UMB is the United Missouri Bank is the distributor of our funds. Just common disclosures that we need to share with you to make sure you're a well-informed investor. Thank you for your time. Please feel free to reach out to me at any time with any questions or concerns you might have, so we can make sure that we can help you get all that answered. Thank you very much.